On behalf of Crosscheck Media and BizTalk Today TV, welcome everyone to the Money Path. I am your host, Todd Schoenberger, and joining me today is Ryan Detrick. He is the Chief Market Strategist at Carson Group. Ryan, happy New Year. Welcome to the show. And we got to start talking about what took place on Friday. We received the announcement about the new Fed chairman, and it seems that markets seem to they breathe a sigh of relief, unless you're a metals trader, of course. But I want to get your thoughts on the Kevin Warsh pick. You don't seem to be very optimistic going forward. Why is that?
Yeah, thanks for having me back, Todd. I guess it's Groundhog Day, right? So happy Groundhog Day to everybody out there.
That's right.
February. I'm in my basement. It's like cold down here again. It's just cold everywhere.
Oh, I
Anyway,
know.
all right. So yeah, I guess he was probably our least favorite. If there's what, three or four names that were in there. I guess I just put it like this. I mean, yes, as everyone knows by now, he's been pretty hawkish historically. You go back and see some of the things he was saying during the great financial crisis, thinking QE was going to cause this massive inflation, which obviously it didn't. So he's more hawkish then. But what gets us, he's been dovish two times, it seems like the last, we'll call it almost 20 years, right? 2017 and just recently. Hmm. I wonder what oh, that's right. He was trying to become the Fed chairperson both of those times. So, I think the issue is going to be on the Fed. Yes, the driver is the driver. I'm sure there's some, I think we could say this out loud, some deal with President Trump. He's going to give some rate cuts this year. We're okay there. But you going forward, are people on the committee really going to believe him? I mean, there are voting members, right? You have to have confidence with the other members. And I guess as of now, we're just a little skeptical. So I think the bottom line for us, you learn a lot about your Fed chairperson during the first crisis, right? I mean, what's it going to be? Who knows? We're going to have some big issue that pops up sometime, eventually after he takes over in May. And what trust will be there? Just know markets tend to test a new Fed chairperson. Buddies over at Ned Davis Research did this research, like the last 10 Fed chairpersons. Market had like a 15% peak to trough correction sometime the first 6 to 9 months. That doesn't mean it has to happen, Todd, but I think, we're just a little skeptical. He's going to be a little more hawkish once his true colors come out. And I don't know if maybe the president won't like that. So we'll just have to see how that goes. And I'll leave it there.
Right. Well, you are correct though, and he really the president wants obviously an aggressive easing cycle. So the
Mhm.
question will be, will this guy Warsh be able to deliver? Because we only had two dissents last week in last week's meeting. We
Yeah.
had four in December. The question is, you have to get everyone on board, and it's not just a rubber stamp committee. So what happens if we don't get rate cuts and through this year? Because, or actually, the better
Mhm.
question is,
Yeah.
do we even need rate cuts at this point?
I was going to go that route because if we don't get rate cuts, maybe it's because the economy's doing just fine. I mean, it's be careful what you wish for. I mean, if he were to, I mean, I think President Trump said he wants like 1% interest rates. We're at 3.5 right now. If that happened, it probably means the labor market's absolutely spiraling out of control. The economy is probably on the verge of a recession, if not in a recession. So there's a fine line there. Now, Carson Group's always been in the camp at the start of the year that we'd probably see two cuts this year. And again, a lot of this is what we've just talked about. Whoever was going to be in charge of Fed had a lot of pressure to do a couple cuts, but then you get to the other side, and maybe you don't need to be cutting. I mean, we've been saying for a while we're in a 3% inflation world, right? We manage about $7 billion on our team. And we're positioned our portfolios to have about a 3% inflation world versus a 2% inflation world. What does that mean? We have more international exposure. We're more diversified. We have some things, if you drop it, hit your foot and it hurts, like commodities, which I'm sure we can talk about commodities here soon. And that's not bad. Historically, inflation runs at 3.5%. It's kind of the trend of inflation. And when I look, the trend to me of inflation is right around 3% going sideways. So it's not spiraling out of control. We don't see a massive spike in inflation like 2022. But the reality is, again, I think we'd still call this more of a dovish Fed than not right now, where we are, even with, with Warsh and where we go forward. But just know this. Last 22 times, the Fed cut interest rates near an all-time high, like they just did last month, like they did in November, and like they did in October during those three cuts. The S&P 500, Todd, has been higher a year later 22 out of 22 times. Never lower when the Fed
Hmm.
cuts near an all-time high. People talk all the time about midterm years, and I do too, because midterm years usually aren't that great. That's the number and the stat you hear. But we had the last 2 years, right? 18 and 22 bear markets, stocks were down. 22 was worse than 18. Nonetheless, wasn't good for investors. We had hawkish Feds back then. I don't think this year specifically we're going to have a hawkish Fed. I do think going out further after the midterm elections and things, maybe we have a little more hawkish Fed, and president won't like that. But for now, I think it's still a net positive for investors, at least in 2026.
Interesting. So, and I would think that there would be more chaos with the Warsh pick actually, because it creates that uncertainty where he's going to actually go and any influence that he has. So that remains to be seen. The next Fed meeting is March 19th. One thing that is up in the air, though, is the labor picture. We just received word in the last hour that the BOS isn't even going to release the January number this Friday, which was originally scheduled, all because of this temporary or limited government shutdown. Here we go again with that BS. So you're going to have to, I'm going to think the metals are probably going to rebound off of that news. But with that said, you guys, investing in metals is a high risk business. You know that. Carson Group just crossed a $55 billion asset under management level. Truly remarkable. But you don't get there by taking how should I say it? It really unsolicited risk, I would say, is how I would call it. Yeah. What do you think on the metal side right now? We had a huge sell-off on Friday off of the Warsh news. Yep. Going forward, how do you see it?
Yeah, so we've been bullish, commodities and gold in general. So we added gold to our tactical models that we run for our Carson advisors back March 31st, 2023. So we've had gold for a while. And I was one of the very few people back in 23, and trust me, people got mad when I said this, but it is what it is. I said, we're going to have a period for years where stocks and gold go higher together. Remember 23, everybody thought it was going to be a recession, and I don't know, people warm and fuzzy about gold. Well, that's been playing out. Now, with gold right here, right now, I mean, on Thursday, gold is up 26% for the year. That's like the end of the month. On Thursday, silver's up 67% for the year. Then silver pulls back. Well, not pulls back. Gee whiz, crashes, 27%. And gold had the worst day ever for silver, and gold is down 8 or 9%, depending on how you look at it. One of the worst days in a long time. So I think that rubber band was just too stretched. We're not surprised to see this. The reality, though, central banks are still buying. There's just hand over fist, to be honest. There are still a lot of reasons I think the U.S. dollar goes lower, in our opinion. So from a year from right now, I would take a pretty good assumption that gold and silver will both be a decent amount higher than they are right now. Where will they be a month or two from now? I don't know. I wouldn't be shocked at all if gold and silver kind of chopped around for 3 or 4 months. I mean, after the run they've had, that'd be perfectly normal, and honestly healthy. Honestly healthy. I mean, you don't want a bunch of volatility. We had looked like blow off tops last week. I made jokes. Some well-known gold bulls that we haven't heard from a while were on these different podcasts. Everybody's talking about silver. And sure enough, one thing we've said that would kill the commodity bull market would be a hawkish Fed. Now, again, we just talked about the Fed earlier, but that news that came out that maybe the next Fed chairperson is going to be a tad more hawkish, that's all it took for those metals to pull back. The bottom line, we have about a 3.5% allocation to gold. We don't technically own any silver, pure like silver ETFs in the models we run, a little too aggressive. We have about a 3.5% allocation to gold. We've had some exposures to metals and mining over time and different things. So to us, it still makes sense to have some of that, but don't go head over heels. Don't go overboard. I mean, the moves these have had been spectacular. But the last comment, if gold just peaked, I don't think it did. We'll be very, very clear. I don't think it just peaked at 5,600 last week, like where it peaked. I don't think that's the ultimate peak, is what I'm saying. I like to look at market history, like to look at market cycles. This would be the shortest bull market in the history of gold, right? Gold just broke out 2 years ago, January 2024. So that'd be, my math is right, about a 3-year bull market. These bull markets, Todd, last decades, at least a decade usually. Doesn't mean every year's up, but these cycles higher. And I think we are in a commodity super cycle. I think commodities make sense. The global last comment. I said last comment 2 times ago, but I swear last one this time. If the global economy is solid, commodities usually do well. I mean, it's kind of that simple, right? The U.S. buys a lot of commodity, yes, but if China, other parts of the world are growing, and they are. This earnings season, we can get into this if you want, this earnings season was really good, okay? We're seeing foreign demand. We're seeing domestic demand. That also means commodities continue to be purchased and bought up, and that is another reason to think that you probably want to own have some commodity exposure in your portfolio, in a well-diversified portfolio. That's how we're positioning for our advisors, at least.
So you're speaking on the commodity side, on the metal side, though. Now, what about oil? I mean, do you have an opinion there?
Yeah, great question there. I think one of the bigger catch-up trades we're going to see in a long time, been saying this for a while, is crude oil catches up, right? Crude oil is at one, what was the other? Was it cocoa or coffee? It was either cocoa or coffee that didn't do well. I like both of those things. But nonetheless, crude oil did not do well. Most other commodities, everybody knows, is way up here. I think that we see a pretty good size catch-up trade with crude oil working higher. And again, the global economy strong. There's demand. But again, these commodities sometimes just pass the baton around. What we've seen in the markets, the U.S. markets, we all pay attention to. Okay, Mag 7, Mag 7, Mag 7. Now it's 493, 493, 493. The S&P 500 equal weight last month in January was up 3.5%, 200 basis points better than the S&P 500. What's that tell us? Well, it's broadening out. That baton gets passed around. So I think energy, is an area like XLE, right? That ETF. I think that's an area that somebody might want to look at and think, it looks really good. It's done well. But then you realize, oh my goodness, it's trading where it was trading in 2007. Literally gone nowhere for close to 20 years almost. I mean, that's bad if you've been in it, but maybe it's good if you want to be owning something that's on the verge of breaking out and taking off. Because how did gold do the last 2 years when it eventually broke out? Yeah, it did pretty well.
That's right. That's right. And to support your thesis on oil, OPEC did say that they're expecting an increase in demand this year because of global, economic strength. So that's another supporting catalyst for you there. Let's turn the page quickly on the earnings side. We're in the middle of earnings season right now. Looks good. Will it continue? Do you have any numbers you could share with me?
Yeah, it's looked really good, and I guess short answer, we do think it'll continue. I think about a third of the S&P 500 has reported so far, coming in about 12.8% year over year. About a month ago, we expected low eights. Back in the summer is like 6 or 7% year over year earnings growth. So once again, coming in better than expected. That's usually what we've been seeing. We're looking at 5 quarters in a row, earnings up 10% year over year. But I want to take a couple of different directions now. The profit margins. FactSet says profit margins this quarter, fourth quarter, could hit the most we've ever seen, okay? Like up over 12%. The most we've ever seen back to 2009 data from FactSet. So profit margins are strong. Earnings are strong. We call those the dual tailwinds to a bull market. I've been talking about these two things breaking out to new highs for like 3 years now. When profit margins are going higher and earnings going higher, usually means the stock market's probably going to do higher and the economy's doing good. Now, one more thing, because we have a lot more names set to report, but the one thing that's caught my attention, industrials, which I've already I think I've talked about industrial. No, I haven't talked about them yet. Industrials, though, earnings are up like 15% right now.
Wow.
Todd, they're expected to be flat. Okay, they're supposed to be up 0. They're supposed to be flat this time a month ago. So earnings, industrials are that one group that, listen, if industrials are strong, I bet the economy's okay. If industrials are weak, yeah, economy's probably not going to do too well. So again, that catches my attention. Yes, technology's beat. Most 75% of companies have beaten earnings. We get all that. There's a lot more big ones to come. But industrials breaking out. I mean, industrials just last week, Friday, closed at a monthly all-time high. I get there are cracks out there. There are potential worries. You've got software that's really breaking down. You've got the staples that are leading, a more defensive area leading. Those things, they worry me near term, sure. But bigger pictures is still a bull market when you have new all-time highs in industrials. There's no sector with a higher R squared, it's called a correlation coefficient, with the market than industrials. Industrials all-time highs is a darn good thing, and it's being led by earnings, which is another darn good thing.
That's right. Well, let me get your thought on this. Today, not only is it Groundhog Day, it's the 10-month anniversary of Liberation Day. Wow. If I asked you on April 1st last year, going into that press conference on April 2nd, are you shocked by what you're seeing right now from a U.S. domestic economy as well as a rising market? Or is this something that you guys figured we were going to be doing all along?
Well, on April 1st, even on April 2nd, I'd probably been okay. It was after the market closed, I think on April 2nd, right, when President Trump held that paper up. That's when it all fell apart. 10.5% drop in 2 days. Everybody's being told to bring nothing on the shelves that summer. Inflation was going to soar. We're heading straight to a recession. All that stuff happened. Now, we were one of the very few places that remained overweight all last year. We kept our target for a 15% return last year. Even we were down 15%. I mean, clearly it's been historic. I mean, the Dow is up 9 months in a row. Okay, that's one of the longest win streaks ever. S&P S&P's up 8 out of 9 months in a row. The reality is no. I mean, I don't think we were quite that bullish, but we were optimistic. But again, that's the beauty of these tariffs, and beauty might be the wrong word to use, but the reality of these tariffs, they're like a dial, right? You can turn a dial up, you can turn a dial down in a hurry, and that's exactly what we saw with effective tariff rates now came in around 12% by end of the year. That's exactly what President Trump said he's going to do. When he held that piece of paper up and effective tariff rates are over 25, everybody freaked out, sold first, asked questions later. That's where we are. And then you look at the massive jumps in GDP, the massive jumps in productivity. Honestly, even we were pretty optimistic. No, we didn't think the economy would be that strong the second half of the year, but it is. And that's why I think we've said remain overweight equities for a while. And that's why we are hitting all-time highs the time practically we're doing this.
We may look back at that day as being the best opportunity really for a generation of an entry point of getting into the markets. I mean,
so let me jump in. Yeah, I love what you said there, because the S&P was down 20% peak to trough. I mean, that's what it was, right? Down 20%, more in other areas, bear market. Everybody remembers it was mayhem. I heard from people I haven't heard from for 25 years. Calling me up, messaging me saying, this is terrible. He has no idea what he's doing. He's wrecking the economy, da, da, da. You know, and I'm like, well, if so-and-so just reached out to me, I'm going to take a wild guess this is priced in the market. And sure enough, that's what happened. But let me put it this way. Volatility is the toll we pay to invest. One of the things we've been preaching a lot to our Carson advisors and their clients, and anyone that'll listen. Every year has bad headlines. Every year has volatility. On average, you see a 10% peak to trough correction a year. You see 14% peak to trough is actually average, and you see one at least 10% a year. You see a 3% or 7 times a year. You see a 5% or like 3 times a year, and a bear market every 3 to 5 years. Okay, so I just threw a lot of numbers out. I get it. There's always going to be a worry. This year's going to have something's going to happen. I bet we have at least a 10% peak to trough correction at some point this year, Todd. It's not a shock. Most years have it. Plans are useless. Planning is everything. President Eisenhower said that one. Let's plan for some volatility, and when it happens, use as an opportunity not to panic, but maybe to either be calm or to actually buy some solid companies that are on the cheap, because this is still a major bull market, in our opinion, and it doesn't mean every day is going to be up. You can have rough days, even in bull markets, like we've seen the last 7 years.
Yeah, that's right. That's very well said. So you are Ryan. You are the co-host of Facts versus Feelings podcast. I love the podcast. I definitely welcome the audience to go check it out. It's very educational and entertaining. One thing, though, you guys do, it's a lot of fun, is you talk about different indicators. And a big one that's coming up this week is the Super Bowl indicator. Tell the audience who we should be rooting for.
Well, thank you. Yeah, real quickly, Facts versus Feelings come out every Wednesday. I do it with my friend Sonu Varghese on our team. We talk about all this stuff. What makes us a little different, we manage $7 billion, right? There's a lot of people at the podcast that just pontificate. When we talk, we're talking about how we look at the world, managing real money. So I think it makes us a little different, but thanks for that. So the Super Bowl indicator, again, let's fully disclose, don't invest in this. I have to say that. But historically, when the NFC wins, the stock market does a little bit better, up like over 10% of the time, higher like 80% of the time when the NFC wins, versus the AFC, about 6 or 7% or so, and higher like 2/3 of the time. But I think it's more interesting when you have a blowout. Todd, when you have a blowout, actually, this is one that I've kind of put a little spin on. No one talks about this. You get better returns, right? When you have like a 21% blowout or more, the market's up substantially. But even when you have a double-digit win versus a single-digit win, markets do a lot better under blowouts. So listen, of course, it's playful, it's fun. But last year, the Eagles won by 18. How'd the stock market do? I'm just saying, So we'll see. It's all fun and games. And a last comment for everybody. The last 13 Super Bowls, the AFC won. The stock market was higher, 12 of them. So I know I said the NFC is better, but lately the AFC has been really strong. We'll see. I guess I'm going to go with Seattle. Who are you going to go with? What do you think?
Well, I'm an AFC guy, AFC North, as we both are. So
me too.
I'm going to say, I am rooting, thinking the Seahawks with McDonald being the coach for Seattle. He used to be the D coordinator with the Ravens, so I'll root for him.
Yeah, I'm an Ohio State guy, so Vrabel walks on water if you talk to anyone from Ohio State. That's just what it is. But I hate the Patriots. I can't help it. I hate the Patriots with so much passion that I don't care. I want anyone else to win other than the Patriots. I can't believe they're back in it. But anyway, we'll leave that there. So go Seahawks.
There you go. I like that a lot, and Wall Street would cheer it as well. Ryan, this was fantastic. Thank you so much for joining me today. I definitely would love to have you back in the next couple of months.
Anytime. Hopefully next time I'm not in my basement freezing. I don't know if you can see my breath or not. It's really cold down here. I got the heat on, I swear. But Todd, this was an honor. Always enjoy doing this with you and everybody watching live. Hopefully you enjoyed that, and I'll be back anytime you need me. Enjoy this Super Bowl, everybody. Thank you.
Yes, you too, Ryan, and thank you, and stay warm too. So on behalf of Ryan Detrick, I am Todd Schoenberger. Thank you once again for joining us on the Money Path. We'll catch you next time. Take care. Oh, that was great, Ryan.
Perfect. Easy.
I think I got you right at 20 too.